Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, president of Universal Accounting Center. And for nearly 3 decades, I've been working with owners of accounting firms, helping them build successful businesses, offering quality accounting services, and of course, getting them paid what they're worth. It's in this process that we've actually had on this show a number of experts, individuals to come and share their insights related to not only running and operating successful businesses, but insights as to how to better service clients, mental health, tech stacks, and a variety of topics that I'm sure you do enjoy and appreciate. So with that being said, I'm excited to have David Safir once again on the show. David, this is your 3rd time.
It is.
I'm excited about that because it's for good reason that you're back. In fact, I can honestly tell you, you are a handful, fewer than a handful of individuals that have been on the show this many times. So welcome back.
Well, Roger, it's great to be back. And when we talked about possibly being back, I was like, absolutely, it's going to be a great conversation. I know it is.
Always is.
Yeah.
Always is. You're a good man, so I appreciate you coming back. So let's give the audience a little bit of backstory as to maybe your introduction to and role in accounting.
Well, I'm not an accountant.
Yes.
And so I did go to business school. I took Accounting 101. Took me 3 times to really get it right. I dropped out the first time. I got a C the second time, and so I had to retake it for graduate school. But now I know what it is from a business perspective because I had to use it as part of corporate America.
Yes.
When I left corporate America, I started applying it to small businesses, and that's where I started finding this cash gap that we're going to end up talking about.
Yes, yes. So with that background, obviously you came from corporate America, but you saw this cash gap, and I think this is where maybe it'd be best to begin. You saw a discrepancy between what it was business was experiencing, what they were dealing with on a day-to-day basis, and the accounting that was occurring in the business, the backward look at what's happened transactionally within the company, but yet the reality of cash flow and the need for that capital to exist for business to operate. And I'd like to just start from that point of view in the sense that as a business person, you maybe saw a difference in vocabulary, a difference in communication, a difference in emphasis. What was it that you were noticing that existed as it related to cash flow?
So let's first make sure we understand that we're talking about for small businesses.
Yes.
When I worked in corporate America, we had all the experts in the world that I didn't have to worry about cash. I worried about receivables, but somebody else worried about whether or not the bills were getting paid, right?
Yes.
So when I came into small businesses, and this is really important for anybody who's listening that has a corporate background, you need to scale back your vocabulary because if not, you end up sounding like a stuck-up expert. I mean, you do. I mean, think about the lawyer who talks to you in legalese, and you go, what are you talking about? The mechanic, the doctor, the people that have very detailed expertise, and that's what you end up with when you're an accountant. Because you go to school, or a bookkeeper, because you go to school, and you pick up vocabulary, so you need to start using plain language, plain English.
Yes.
And I had to totally change my vocabulary when I started working with small businesses. That was the first gap I encountered, and it takes courage because people would look at me and so finally say, David, I don't understand what that means.
Yes.
And I have to step back and go, oh, I'm so sorry. Let me rephrase it in simple language.
Yeah, so let's talk about this for a little bit because there's this reality of how business is and the language we use to describe it. It's notorious. Accounting is the language of business. We get that. But there's something that occurs when I've spoken to business owners where they literally will glaze over. You look at them in their eyes, and they're unwilling to admit they don't understand. They're unwilling to say, can you clarify? They just don't want to embarrass themselves. And I've got some stories that I could share regarding that, and I'd love to have you share some. I distinctly remember when I was working with a particular client, and it was a husband and wife, co-owners. They were both very involved in the business. Each had very distinct roles. And later, I learned from the spouse, she was communicating how meeting with me was so intimidating that she heard my voice, my booming voice when I was originally scheduling the appointment. And one of the things that she communicated was that in that first meeting, she was embarrassed. She knew or expected to be asked questions about their company that they thought they couldn't answer. Right. And at the end of the day, it was questions about the financial stability of the business, just because I was wanting to understand it and so many other things. And she realized, we know our industry. We know what we do. We know how we're working. Not necessarily whether or not we're making money, but they knew what their business was. but they couldn't describe it financially. They didn't know how to articulate it through financial statements, income statements, all these types of things. But yet that's where we wanted to ultimately end up, is in the numbers. And that was where they were uncomfortable. Have you experienced that before?
Well, absolutely. And I'd like to suggest that accounting is the language of big business. I'm sorry. It's being shoved down the throats of small businesses. And as far as I'm concerned, what we should be thinking about for small businesses is cash. Think cash, not accounting, which is one of the things I talk about when I've got a mastermind and people who are getting certified in what I do, which is cash flow advisory. And this is one of the big obstacles, is stop talking about accounting, because if you want cash, you've got to talk about cash, and they are completely different. And the best example I have, and I have talked about my friend Wally, who handed me his financial statement, said, my accountant tells me I made, what the heck does that mean? I've got $250,000 in profit, which is a made-up accounting term that is not real money. It's fantasy out of a whole bunch of different constructs. So I had a $250,000 and $2.1 million in revenue, and which is also fantasy because it was accrual-based accounting, and it's theoretical $2.1 million. And I don't know where my cash is. And I said, so Wally, what does your accountant say when you ask him where it is? He has no idea how to explain it to me. That was my biggest introduction, going, wow, there's this huge problem that we've got. And I started deconstructing and trying to figure out to him plain language. My first client, I was out of corporate America. It was my first small client that I was doing full-time advising like this. And I go, okay. But my mind was going, how the hell am I going to figure this out? And that was my introduction to figure out closing the gap.
I'm really appreciating your explanation of this, because that story, I think, very well describes what I think a lot of small business owners experience, which is a frustration with the accounting world. Why? Because they're interested in the cash business. Mm-hmm. They're wanting to understand cash accounting, as we would describe it. And what we're doing as accounting professionals is we're trying to elevate and push them towards accrual accounting. And they play different roles. They serve different purposes. Right. And for the small business owners, so much of what they're doing is cash-based. They want to understand the cash numbers. How much money did I physically bring in and get deposited this month? How much is left over in the bank? And from a cash point of view, that's how they're operating. They want to know, is it, cash being king, do I have any? Well, the accrual is trying to say the activities that you're doing are profitable. They're producing revenue, and they're showing an ROI. We're trying to, from an accrual point of view, tie everything together from a time perspective. Well, cash, I just want to know, did I get the money deposited in the bank? And who cares from what work did it come from? I just got paid. That's exciting. I can now pay a bill. So all of a sudden, what you're trying to talk about here is, I think, something that does resonate with the business owner. They need this perspective. So let's take it a step further. We already see now this discrepancy and the two different things that we're discussing and the need to talk to them in cash. Mm-hmm. So how do you accomplish that? Because we do have some accounting goals and objectives that we're trying to do. We're going to prepare financials for tax returns and so forth. So there is that side. But how do we meet the need of the business owner who wants that cash perspective?
All right. So first of all, let me make it clear that I don't dislike accounting.
Of course.
All right. No, well, some people think I just want to get the industry shut down, which is ridiculous.
We could have that as another conversation.
Well, that's a different issue.
There you go.
No, I don't want to. But it's funny because accrual accounting depends on a theory called going concern theory. Do you remember that one? That says this is because we're doing it like this because we're having a going concern. Too many small businesses are going out of business. They're not a going concern, and they will not be if you just use the accrual accounting. So what do? Cash flow, projections. This is one of the reasons you need great bookkeeping, accurate and timely. If you don't have those two, forget about it.
Yes, those two words are very appropriate, yes.
Oh, great. So you start out with accurate and timely bookkeeping, and you create a cash flow projection that does 13 weeks minimum. That's the standard. If you work with the bank and you're in trouble, they will ask you for a 13-week cash flow projection. And you just lay it out in cash, all the money that's planned to come in, all the money that's planned to come out, including the hidden categories that don't show up on a P&L, and they sort of show up on a balance sheet, such as return of capital. When you make $1,000 payment and you're repaying $100 of capital and the rest is interest, well, that $100 of capital doesn't show up. $100 is not a big deal. Let's flip it. $900 in capital is being returned. It doesn't show up in your P&L. You're getting paid as a business owner. It doesn't show up in your P&L. You're buying inventory, and it doesn't become an expense. This is a really fun one to explain to business owners. That's not an expense. You just spent $100,000 in inventory. There's no expense there. It's called an asset swap.
Yes.
You're going from one asset to the next.
Yeah.
It's an accounting theory. Now, if you're using cash-based accounting, it does become an expense, but this is where some of the confusion comes in. But you get all of the ins and outs going onto a spreadsheet and you lay it out. And I can tell you from personal experience, I had two business owners that were in real trouble that a bookkeeper brought to me. It said, David, can you just talk to these people? And they hired me. I said, I don't know, based on what you said, I don't know if I can help you, but why don't we look at the cash flow spreadsheet? 2-hour conversation. And they said, wow, I finally understand my numbers. Because it's a checkbook, money starting with coming in plus, going out minus, ending balance. You can do it with a pencil and paper. Then you start over again the next week, and it's up and down and up. These folks walked away saying, wow, we finally understand what's going on. And then here's the really interesting thing. We did a follow-up conversation a week later.
Okay.
He was so excited. One of the business owners, who's the key operating owner, said, David, we just had our best week ever for bringing in cash. Like, what happened? So when I understood that I stopped focusing on getting deals booked and stuff, I just focused it on how do we get to the stuff done that we need to do to ship it and get paid, because everything was paid credit card, right? So they are 2-day delay, maybe cash. So that's all he had to do was focus on getting paid, and it made all the difference.
So I'm going to speak to two things here that I think are very important. One, this exercise of going and projecting out the 13 weeks. Mm-hmm. I personally find that fascinating because when I've done it, and it's been very few times I have done it, admittedly, but when I've done it, one of the things that I've noticed is how good is the forecast, which is to say, when you go out those 13 weeks, the premise of those is based on the historical tracking, right? So how well do you know the business, both the accountant, bookkeeper, but also the business owner? And when you put these forecast numbers out, the question is how well are you nailing week 5, week 9, week 10? Because you're looking at that deviation of, is it a 5% difference? Is it a 10%? Is it 30% difference? In other words, how well do you know your business? Mm-hmm. And I think that's a worthwhile exercise to go through just to simply understand, do we know what our company is really doing from a cash flow perspective? And if you do this exercise and find that you're spot on, which I have with one of my clients, I've actually done something similar, and it was quite rewarding to realize, I guess we do know our business because look how accurate we are with these numbers. But there was another time where I remember it wasn't even close. What we anticipated or thought, we were off. And I think it was a testament to the fact that we didn't know the numbers well enough. And so it caused a greater scrutiny of the financials. And through that process, I think the business owner particularly came to understand and appreciate the numbers more because they wanted to get it accurate. Second thing, when it comes to measuring, tracking numbers, one of the things I have noticed is when you measure something and track it, and then not only track it, but report it, actually discuss it and talk about it, it improves. What you're doing there is you're drawing attention to, even at a subconscious level, this is what matters most. Of all the noise going on in business, this is what matters. And to your point with the example of the business owner, it improved only because they realized we're watching it, we're tracking it, and this is the priority right now. And they're going to do what's needed to make this thing work. And all of a sudden, just because of the attention, it ends up working well. Would you agree?
It's a good part of it. But the other thing, when you're looking at cash flow, you realize the mistakes you're making.
Yes.
Well, which is part of, you're saying, paying attention.
Yes.
So absolutely. And things like, boy, Roger, there's a couple of strategies I've got. One is go find assets not on the balance sheet that have been fully paid for, fully depreciated. They don't show up anymore. And that are saleable assets. That could be a chunk of cash. And I've also just recently had a client who we found an unrecorded liability, which is not unusual.
Yes.
Right? Credit cards and other things that don't show up on the balance sheet. So you're fixing and you're becoming more aware when you're looking at your cash coming in and out, because it's reality, it's not theory. And theory is too easy to go, you get to make decisions. Are you going to do accelerated depreciation or straight line depreciation? Right? Yeah. And so it's like, anyhow.
Well,
so
the one thing I'd point out is, through the exercise, having done this in my own business, when cash is good, there are things that are minor expenses, the $10, the $20, the recurring billings that is $100, that all of a sudden starts to become insignificant in the sense that you're not paying a lot of attention to it. Mm-hmm. Well, when you sit down and now actually look at things line by line, you'll find things like, why are we still paying for this? And who authorized this a year ago, and it's still showing up as this recurring billing? And honestly, there are things that I have questioned that I've come to find out that people once were using and forgot that they had it available to them as a tool, and now they're utilizing it again. They're like, no, don't cancel it. I need to be using that. Okay, well then use it. And so you go through this thing of accountability, and it's basically saying we're going to be very, very attentive to where we're spending the money. It's not just we're a cash cow here and we spend indiscriminately. So I appreciate that discretion that starts happening in the business because of that attention.
Yeah, anybody who hasn't done this in the last 3 months should go through and see the worst case I ever had of this, or the best case, depending on how you look at it. About a $1.2 million company. They had huge margins, and so they had a lot of discretionary spending. The owner went through and found $14,000 worth of unused subscriptions.
Yep.
$14,000 a month.
Oh, my heavens.
A month. Because they were enrolling in these high-ticket, very focused groups, and they forgot, and they just kept going and paying. $14,000 a month.
Yeah. Well, I can't agree or relate to that volume, but I can say that I've admittedly signed up for some services that initially I had the best of intentions of utilizing. I might have dabbled in them originally and hoped that I would actually utilize them more. Something else comes along, that shiny object, and all of a sudden that thing kind of gets pushed aside with, again, still the best of intentions. But then all of a sudden a month passes, a second month, a third month, and you start to realize this isn't something I'm going to utilize. And it's kind of akin to Netflix. You know, I didn't watch Netflix this month. I'll just pay for it again the next month. Who wants to go through the hassle of canceling it and then turning it back on? So I'll just pay the subscription, $15, $20 or whatever it is. But at a business level, that adds up, and oftentimes they're larger sums, like you're indicating.
It does. You know, I'd like to congratulate you on actually getting something accurate the first time. It's never happened to me.
What's
with
that?
The cash flow statement. I've never had a cash flow statement or cash flow projection that I got it right the first time, that five weeks from then, I look back and go, yeah, we were pretty spot on.
Yeah.
And it's okay. So this is another one of the challenges bookkeepers and accountants have, and business owners have, of doing cash flow projections, is they'll never be exact. I come in close. Well, the way I look at it is 2 to 3 weeks out, it's really good. 5, 6 weeks out, it's okay. 5-10% deviation. And the benefit of going out even further is to see those big problems coming in.
Yes.
So you get the visibility. But people don't like to be wrong. And one of the fundamental premises of accounting is you get it right, you document it, and you reconcile, and it is accurate. There's a materiality, you get to ignore a few little things. So getting that mindset going from, okay, don't worry about being right next week, especially when you're getting going, and it'll never be perfect, is really hard to overcome. It's one of the obstacles some accountants have, or bookkeepers, and business owners have to take a big breath and say, okay, that's a projection. I don't have to know exactly what my sales are. I can make a reasonable guess.
Yeah. Well, here's why I'm going to kind of elaborate a little bit. When it comes to cash flow projections, one of the things that I have experienced myself missing is you've got this annual or semi-annual payment that's due for, let's say, the insurance, or maybe it's the phone system or the CRM that you're utilizing. There's something that you're making annual subscriptions or payments for, and you forget that. And from a cash perspective, it's this unexpected cost that all of a sudden you didn't foresee, but yet it's going to be paid. And it's those nuances in the business that when you're working with a business owner, they may or may not realize. They just assume that what they're paying this month this week is going to be paid again next week. And they just think it's cyclical, right? Well, all of a sudden they get these gotchas. Oh, I forgot. I'm supposed to pay this $10,000 thing every month or every year in February. I forgot about that. There's this thing that I usually do. So those discussions I think are healthy ones, because especially when doing forecasts, those are the things that become very helpful when you're trying to get your accurate numbers. So this discussion here I'm finding to be very, very helpful. So let's take it to an emotional level. You've got business owners, they're dealing with cash flow issues, you're trying to help them. What are some of the emotional connections they have to the cash as it relates to them wanting to manage it more effectively?
Well, first of all, if a business owner ends up in trouble, it can be anywhere from disturbing to emotionally devastating.
Yeah.
Lack of sleep, trouble with relationships, and it's because of the pressure that they feel for having to pay bills. And the best thing that I ever hear is not the money. It's the, David, I'm sleeping better. David, I have hope. David, I can see a light at the end of the tunnel. David, I think, and my spouse just told me that I seem less stressed these days. I'm not sure if this is the type of thing you were looking for when you asked me the question, but they're so tied together. I mean, I've been there. I ran a business that was real estate related. 2005 we started. Well, 2006 was the start of the real estate collapse in the United States. And we held on to 2012. You notice the term I used was held on. Certainly didn't thrive, but we did okay, and it was because I knew how to manage cash. But we finally got to the point where I wasn't sleeping, etc. Something happened that triggered, and we did a voluntary shutdown of the business. We did a structured shutdown, which is an option to a bankruptcy, which gets, anyhow, doesn't really matter. So I know what it's like, and I've seen it, and it impacts, you carry around the weight on your shoulders. Until the best thing, the moment of relief was that decision moment when we said, fine, it's getting shut down. And all of a sudden, all the tension went away because you're struggling to hold on. What I see with small business owners, it's when they take that first step to say, I've got to do something. I cannot keep going the way I've been going. And you make that decision is when the tension starts to go down, and when you actually see a solution that can say, okay, now I can work with this. I still got my accounting reports, but I can actually start projecting and managing. So modeling is that first step. Then you start managing, which is simply trying to pull in receivables and push out payables.
That's right.
And it's amazing. Just by moving one thing, you could go from real trouble to, oh, we're okay. I just did that with my business. I realized we could pay a bill, and we were looking at negative numbers every 4 weeks. I'm like, well, what if we shifted this? Oh, we're fine.
Yep.
And this is, most businesses can do this type of simple cash management. And most businesses that I work with, that's all it takes. It's not more credit. It's not more sales, and sales can put you in a deeper hole before it pulls you out. It's nothing new. It's within the norm of how they're operating. They can get out of trouble.
So I want to address what you just ended on, but I want to go backwards a little bit. You're right. I think the game in its most simplistic form is how do you collect faster and pay later.
Yes.
And the longer you get to hold on to the monies, be maybe the one earning the interest, but more importantly, separating the difference between what you're collecting and what you're owing, that brings peace. And the larger that gap, the more peace you can have because you have that float that you're doing between the two. So any business owner that can learn that, that's where the power comes, is those two things.
Let me throw in a third one.
Please.
Liquidating assets. And when I say liquidate, doesn't mean, 2 cents on the dollar. I'm talking about paid in full inventory that doesn't impact your cash because you've already paid for it. How do you move that faster? And believe me, that's a huge mindset when you say, well, just discount it. Go sell it to your competitor outside your market area. They're not really a competitor, but they sell the same thing you do. Maybe they want some inventory at 5 or 10% below cost from the distributor. It's brand new product. So liquidate your assets, paid in full assets that aren't being used anymore. That's another huge opportunity for cash. All right. So something else that's in your control and within it's managing, you're turning the cash buried inside your inventory or inside a powered diesel generator sitting in the back, the size of a train. This is a real story. Go sell it. You can pay payroll for 2 or 3 payrolls. Just sell the damn thing. Well, I don't have time. Make the time. I'll sell it. It doesn't. So anyhow, sorry, I had to throw that one in.
Well, no, it's good because you're actually taking something that's perceived perhaps as not being liquid assets and you're liquefying. You're actually turning it into cash again.
Yeah.
So no, that's important because right now we don't deal with chickens anymore, right? So that diesel generator isn't something that someone's going to take as part of their payroll compensation. No. But yet you can turn it into cash to make payroll. So they may not necessarily see some of those assets as liquid, and all of a sudden they're able to actually monetize it, right? So
so that's part of the management part.
Yeah, very good point. All right. No, what I wanted to go back to is this idea of the emotion. Yeah. And you're dealing with small businesses, and in all business, I think the president, the owner, all these individuals deal with it at different levels, but it's more obvious with the small business owner where there isn't a commingling, not of personal and business funds, but of emotion.
Oh, yeah.
And all of a sudden what happens is you deal with, at least I've experienced, business owners who struggle distinguishing their financial well-being personally and with the business. And when the business is struggling, they're struggling. And it's not that they don't have necessarily the lack of monies to pay their bills or feed their family, but sometimes it is. And it's that integration of the two. And when that cash struggle occurs in a business, the emotional isn't just the business is struggling, it's the home is struggling.
Right.
And you are right to point out that there has to be this separation. You've got to somehow help them see that they're not needing to be as intertwined as they may be. So as a business owner, what we're hopefully helping them experience is this separation of those stresses so that they don't have to take it home necessarily. But that's easier said than done.
It's much,
Yeah,
much
here we are. We're just basically saying, well, this is what you need to do. But at the end of the day, it's emotionally draining. At the end of the day, they're emotionally vested in their business, and cash is elusive. And so all of a sudden, what we're seeing on paper, they're experiencing emotionally. I just wanted to see what conversations are you having with them as it relates to their relationship with money?
Can I pile on more first?
Please.
About the other pressures?
Please.
A lot of small business owners employ other family members.
Correct.
Or their employees become like family.
Yes.
But it's not just them. It is also their suppliers oftentimes are close relationships. So if they go bust, their suppliers don't get paid. And the same thing with their clients become people who know and depend upon them. So it's an entire ecosystem that I've done the numbers, and it's hundreds of people that can be impacted by a small business failing. So whether they're conscious of this or not, they're certainly conscious of their siblings or the family members. So the conversations are about a little bit of breathing, right? I actually went out and got a certificate in counseling. I didn't go to online certificate, but it helps. to be able to say, listen, I know this is bad, and you're just honest. It's not brutal honesty. It's very open honesty about, yes, this is not a good situation. But if you take action, you can improve it. Will it work out in the end? I'm not sure yet. Some businesses I can say, we will get through this. I can see how to do it.
Yes.
But to other businesses, I am not sure. But keep taking action, because if you freeze, which happens all too often, nothing good will come of that.
Yes.
So it's getting them to breathe, start taking one step at a time, identifying the strategies that can be used under those circumstances the business finds themselves in, and positive reinforcement. You know what helps, I think, more than anything else is saying, this is not unusual. Oh, yes, don't worry about it. This was not stupid. I've seen this a dozen times. This is very common. This is why it's common. You haven't been trained as an accountant, so it's obviously you're a great whatever it is they're doing. But nobody ever taught this to you, so how do you expect to know it? And just telling them, the woman who said she felt intimidated,
Yes.
helping unintimidate them really brings down the stress. They feel stupid. They feel like they're failures. It's like, no, look at this wonderful business you've built. It's incredible. I haven't built a business like that.
Yeah, what I found was interesting about that, it was a multi-million-dollar business, and yet she was intimidated to speak with me as if she didn't know what she was doing. That her and her husband were incapable or incompetent. And what are you talking about? You're running a multi-million-dollar business. Granted, you're dealing with challenges. Yeah. You have struggles, but at the end of the day, things are okay. So the other thing that I'd like to also point out is this. You brought up the emotional component. Mm-hmm. Just like a doctor has a bedside manner, the accounting professional needs to have that sensitivity, needs to be aware of the emotions attached to what's going on with this business owner. An indifference to the numbers of they are what they are and they're your numbers, not my numbers, really doesn't go very far. What they're looking for is they're looking for some understanding and sympathy. And it's very true. Oftentimes as accounting professionals, we know more about that business and they're confiding in us more than they're telling their management, their spouses. There are conversations that as accounting professionals, we should and perhaps are having with business owners that they're having with no one else. And we need to have a bedside manner about it. We need to be somewhat candid at times, be able to point out the obvious, but at the same time, we need to be sympathetic and understanding and listening. So I liked how you brought that in because I think that's such an important part of what we're doing as a role in this relationship with their business. But I want to go back just because it did touch me is this connection that business owners have to emotions beyond just themselves. I had a very important conversation with my brother. He has a business, and in his business for the longest time, it was how he raised his family. It's how he provided for his family. Well, in time, because of the successes he had in his community and the growth of his company, it turned out that as his son got older and started his family and got married and had children, he continued to work with the family business. As his daughter got married, the son-in-law started to work for the company and was now providing for those grandchildren. And then in time, it was his daughter who got married and she had children and she was working for the business and he still had his children working for the business. It wasn't just his family's livelihood. It was his family's livelihood. It was grandchildren were dependent upon the success of that business. And he expressed the frustration, the concern, the stresses he was experiencing because if it went bad, it wasn't just whether or not he could put food on his children's table, his family's table. He saw the extension of it. And so, yeah, it is something that is, I think, sometimes misunderstood that as business owners, it's just them individually struggling and they just need to separate themselves from the business because it's no. It's much larger. And I appreciate you pointing that out.
Yeah, thanks. And, it's really true and it gets scary. Mm-hmm. Even if the business is going well, there's probably still pressure to make sure it continues to go well. Let me go back to something you said about we know the business better than the owners do.
Yeah.
I'd like to modify that slightly to that we know the numbers in the business better than the owners do. And the reason I differentiate that.
Oh, no, I would actually agree with you. You don't have to. No, I agree with you.
So
if I said it that way, I was misspoken because they know their business better than we do.
Right.
We know the numbers.
And so once you get beyond the managing and as a consultant, when I go in, I start talking to people because people, here's one another misconception. Well, it's the accounting department's problem that we're out of cash. No, they're reporting what happened already. Let's start out with the sales department. What are the product marketing, depending on how big the business is. Every single business has all these departments. It's about how many hats people wear.
Of course.
Margins, and sales and contract terms. And if you've got a manufacturing firm, sourcing and how you're buying stuff. The biggest wins I get is from walking around and talking to people about what they're doing, what they're up to, why they're doing it that way, et cetera, and asking questions. That's where all the cash is. And that's the business owners or the people who work for them will know so much more about their business than we can ever learn. And that's where all the gold nuggets are.
I love this. This is wonderful. So
can I give you an example?
Please, David,
I think you're going to
please.
like this one.
Do.
So I'm doing a consulting gig. It's not full time, but the manager keeps leaving and say, I'm going out to the hardware store for 15, for whatever. It doesn't matter. The fifth or sixth time I finally said, what do you keep going out for? Well, we've run out of credit with our nuts and bolts supplier. And so I'm going to the hardware store because we ran out of nuts and bolts. I'm like, okay. So long story short, I had a friend who had a specialty, it's called fasteners, nuts and bolts.
Yeah.
Saved $96,000 a year on nuts and bolts going from retail because I asked the question, why are you leaving? Going to a specialty distributor on a business that was generating about $1.5 million. Nuts and bolts. Went from 10 cents a piece to a fraction of a penny a piece.
That's fascinating.
That's where the money is.
Yeah.
Gold nuggets.
And it's because you asked the right question.
Just ask questions.
Yes.
Ask about what's going on.
And they know their business.
Yeah.
What we can do is ask good questions.
Yeah, and I asked the question about something that was obviously not functioning well, right? Managers for a manufacturing plant shouldn't be going to the hardware store a couple times a week.
That is so good. All right, so what is a common misunderstanding about what it is you do or promote?
I think one of the common misunderstandings, so I do consulting, but where my real focus is on right now is teaching others to do what I do. Mm-hmm. There seems to be a gap, and I already told you I'm not an accountant, I'm a business person.
Correct.
So I'm trying to bring my business knowledge to bookkeepers and accountants. One of the misunderstandings is that they already do cash flow, but they really basically, and this is the same for the software out there, see what your cash flow is. Well, it's this week's or it's last week's cash flow. See what your cash position is today. But without that projection, people have a misconception in general about what to do for helping clients. Or they do know how to model and they do know how to manage cash flow, but they miss out on the mentoring aspects of it, which we've touched on. They've missed out on the mental aspects of it. This mindset, that would be a better term, mindset of thinking cash, not accounting. And even worse, they don't know how to maximize cash flow and profitability, because once you start, you notice I talked about cash, the nuts and bolts.
Yes.
Well, yeah, you increase the cash flow, but that was also bottom line profits.
Correct.
So when you're focusing in on the cash, when you get past the basic move money in and out, you get to significant profitability gains. We're talking 10, 20% of revenue. And that's where there's this misunderstanding that you can do so much just by focusing in on cash and finding those gold nuggets.
I appreciate that. One of the things that I think is important to emphasize there is the attention to cash flow management does manifest itself in the ROI, in the net profit. So putting your energy and effort into this does pay off in the long run, but obviously in the short run, especially from a cash flow perspective. So I think there's some domino effects going on here. So the other question I had is, you obviously see value in working with people from a cash flow perspective. Mm-hmm. Is there anything that you would want to say about a cash flow statement?
Yeah. It's the worst statement that's ever been created by mankind. Well, all right, the accounting profession. And that's not just me. Uh-huh. I have a friend who's on the International Standards Accounting Board, and we talked about this issue when I was first getting started working on cash flow. And I said, what's the deal? And he said, oh, yeah, we know there's a problem. We don't know how to fix it. I have to relearn it every single time I look at it.
Yes.
And it's a snapshot. You could try to do it over time, but then you're trying to do the mental gymnastics over time, saying, okay, so the minus on inventory means that I reduce my inventory. I'm not making this up. I can't remember if your inventory goes down, it's decreased, but that's positive for cash flow. So it's the exact opposite. Do you remember every single time you look at it? It's just
No, I will admit, it's one of those reports that when I look at it, I have to I've got to pay attention as I'm going through it, because I don't want to just necessarily focus on whether or not I have more cash now than I did at the beginning of this say 30 days, right?
Right.
It's not just a simple question of, do I have more cash than 30 days ago? I've got to look at the movement of the monies throughout it, and that's what the report's intending to help with. And so, yeah, you've got to intentionally and deliberately look at each of those lines and see, is this telling the story that I recall experiencing in the last few weeks? Yeah. And so that's one of the things that I admit, it takes a moment. It's the less intuitive of the reports.
But so let's take inventory again.
Yeah.
Set up a freaking graph. Just track your inventory over time. Uh-huh. That will tell you all you need to know about whether it's going up and down without doing mental gymnastics. So I avoid it.
Yeah. Next question regarding budgets and forecasts. Yeah. Obviously, we're talking about forecasting cash flow. Talk about the actual budget or forecast that a business should also be doing.
In my opinion, they should be doing a cash flow forecast. If they're looking at a budget, do it on cash basis. Okay. I'll give you a good example.
Please.
A company I was working with, bad shape. A construction company, have all the normal challenges of cash flow for a construction company. And they were trying to get a bank loan. And they said, great, provide us a cash flow projection over the next whatever number of months. So we did. And they came back, oh, no, you did this wrong. We want an accrual-based projection. You want an accrual-based projection of profit and loss. Is that what you're asking for? Yes. Boy, did that look great. It looked wonderful. And they got the loan. Yes. And 3 months later, the money was gone exactly like the cash flow projection predicted.
Yes.
So, unfortunately, if you do budgeting based on accrual accounting, it's all theoretical. So if you have a theoretical 30-day receivable, but reality is 45 days, if you project based on accrual accounting, you're never going to catch that. And it's the same thing with all other lots of the little different parts of your business. And budgets, oftentimes, if it's more of an accrual-based budget, I'm going back to corporate now because I haven't used a budget in a long time.
Really? Okay.
Well, unless you call my cash projection is what I use. I do an annual cash projection using.
Well, of course, that's a forecast.
So that's a forecast. That's what I do for budgeting.
Okay. Yeah. Well, that's still valuable. That's still important.
That is great. Do it like that. 100%. 2 thumbs up. Go for it.
Well, I think this is actually addressing what I was hoping we'd kind of get into. The difference between a forecast based on accrual versus cash, which is now what you've already addressed. Because, yes, the accrual is very important. It's showing the association of the labor, the work going on in the business, and the various things that are occurring to grow the business. Because we want to see how quickly are we going to realize that turnaround of the ROI based on effort. Okay, yes. But that's a totally different story or narrative than what's going on with the cash flow. And you've said it already, but I don't think you elaborated on it. You can actually show show that you're doing very well financially from an accrual point of view because of the sales that you're making, and yet the company is losing money left and right, and you're digging a hole, and if you do not address it, you're going to be cash poor, cashless.
Yes. And that's exactly what happened with this client of mine. It looked fantastic. You know what else does that? Contracts, new contracts. I alluded to this when I said new sales can dig a hole.
Yes.
So I was working with the federal contractor, somebody who lent to federal contractors. And we said, okay, you get a new contract. And you've got to hire people 2 months ahead of time to train them.
Yes.
And then they go do the work 30 days, and then you can invoice. And then the government pays in 45 or 90, whatever it was.
Yes.
You've got a 6-month gap between starting to spend money and the first dime comes in. And this is something that every company should be aware of. What does it cost to grow sales? Do they have a viable business model to grow sales, or will they need more and more and more capital, which is okay if you can get the capital? But oftentimes, the companies in the worst situation are the ones that are growing quickly, not going downhill.
All right, so I'm going to elaborate on what you just shared because I think I can add to what you're explaining. So one of the things that happens in business is you get excited about perhaps a new marketing strategy, something that's going to go out as a campaign, and you're going to generate some sales from this. Well, admittedly, you've got to start the campaign with investment. You've got to start advertising. You've got to do this promotion of whatever the product or sell is. Well, similarly, you've got to now anticipate what kind of demand that's going to be on the company from a sales perspective. You got to hire salespeople and so forth. Well, this is all great. These are all payroll and advertising expenses that are being incurred long before a sale's ever made.
Yeah.
So now, all of a sudden, what happens with the salespeople is typically they're paid a commission for sales made. Well, that's great. Now they're selling, but you're still not making revenue. So all of a sudden, you've got payroll, you've got commissions, you've got advertising, you've got inventory to perhaps fulfill these sales, still no revenue. And so to your point, all of a sudden what's happening is from an accrual point of view, you're attributing all of this growth to the month in which it's perhaps happening with the advertising spend and the payroll, but there's no cash. And so if you do not plan this correctly, you can quickly find yourself in a position where you can't make payroll. You can't pay for the inventory. You cannot pay for the things that you're needing to do for this phenomenal yet wonderful advertising campaign that's going on. And I've seen it. I've experienced it. And so all of a sudden what's happening is you're seeing the correlation between the accrual and the cash because they tell two totally different stories. And what the business owner experiences is the cash flow side.
That's reality.
That's the reality of it all. Yes, because from an accrual point of view, yes, it's nice to know that the efforts are paying off. It's wonderful to see that the business model is profitable. I mean, that's a narrative you need to know, but I need to live in reality and understand what's happening as it relates to the cash flow. Is there money in the bank to pay the bills? And so that's one of the things that I think is hopefully coming through in this conversation is the value in the two, because I think too often, or at least a lot in the conversations I have, there's this drive to put them on accrual, and I see the value in it. I run my business based on accrual. I love it, but I'm also reluctant and hesitant to celebrate the successes because I see what's in the bank.
Right. And that's unfortunate because you want to be able to celebrate. So you have to figure out how, when, where. And frankly, it's not the checking account balance. It is the long-term reserves.
Yes.
It's this, what else are you doing to secure the future?
Yes.
Do you have reserves for the tax bill? You didn't mention taxes.
No, we haven't gone there yet.
Right, that's that annual surprise that shouldn't be a surprise. Do you have the reserves to pay the insurance? Do you have, all these good things? Those are celebratory. And yes, selling is fantastic, but if you're not able to, you cannot eat profits. You can't go to the supermarket and buy dinner with profits. You have to use cash. So that's the big, it's we could sit here all day and give so many examples.
Oh yeah, no, I think we're definitely hitting home because this is an emotional thing, and I think we're reflecting on maybe customer experiences, client experiences that we've genuinely had, and it's good to illustrate what we're talking about here because it is real world situations. So I think this is good. So here's the question I want to have is you have a lot of strategy. I know it's over 200 strategies to address cash flow situations, and in past conversations we have alluded to a few. I think it be appropriate to share some of those right now? Just give me 1, 2, or 3 that are perhaps less obvious, but yet very impactful when it comes to helping maybe address a cash flow situation. One of them you already brought up. It was obviously assets. What do you have that you could perhaps turn into cash?
Right. And so I'll riff on that. It's very interesting because a lot of them are opposites. So one is find an asset that you own and have equity in, sell it and lease it back with lease payments. So you get a chunk of cash out of it.
Yeah.
You're still paying for it. Or go refinance something. You've got a free and clear car or truck. Well, fine, go refinance it and pull out some cash. And you've got to have a way to know that you can pay that off. And you've got to be smart with what you do with that chunk of money, because now you've got another incremental monthly payment. But that's a good one. But here's another one. Pay off the vehicle. You only owe a couple $1,000s on it. Pay it off and get rid of the monthly payments because of whatever they're high interest, etc. The other one is you're leasing something. Well, maybe you should go buy instead. This opposite, this duality.
Yes.
Lease something that you currently own or buy something that you currently lease. You've got to do the math on those. It's not a simple, obvious answer. So there's a couple that are not so obvious. Some other ones are, which this is number 239, use a cashback debit card. And people say there's cashback debit cards. Yes, there are. United States and Canada. Canada has 4. The United States has about a dozen. One's offered by Discover. Zero risk. It's a little bit of pain because you've got to move your money over to these banks that offer it. But it's zero risk versus cashback credit cards, which are free and easy, right? It's super easy to get one of those. But I consider anything having to do with credit cards to be high risk. But that's another strategy. If you can just put everything through a credit card or one of these debit cards, you can add to the bottom line. It's, oh, Dave, it's 1%. Well, think about it. If you have a net profit of 5% and you can grow that to 6%, that's a 20% increase in net profit. And it adds up. Should I keep going?
Oh, please.
Believe it or not.
You're riffing very well here.
Believe it or not, it's hard for me to recall on demand because there's just so many of them. Well, and so my brain gets stuck.
Well, I would respect the fact that you've got so many different ones because different businesses benefit differently from different ones.
Yeah.
I mean, a manufacturer is going to be different than a service-oriented business. I mean, there's different strategies that each could leverage to their advantage simply because of the nature of their companies.
And what is the situation they're in? So let's take another duality. So this is good. You helped me prompt my brain.
There you go.
All right. So one of the things that happens is you go out and read 10 things to help improve your cash flow today. Almost every single one of those will cost you money and will be long-term cash flow reductions. So short-term gain, long-term pain. So if you need cash, great, but you get out of those as soon as possible. I'll give you for an example. Discount your receivables to bring them in sooner. Give a 2%, 5%, 10% discount. It works. It works great. I've seen it work. And if you need to make payroll, go do that. But you're just cutting off your long-term cash if you keep doing it. And as a matter of fact, what's the opposite? Extend payment terms. If you have enough cash, become the bank. And you got to be careful that you've got good credit-worthy clients, but especially if you have high-margin products and maybe they need to put down 50% first, and then they can make the rest of the payments over the next 12 months. And you get to collect 2% a month. And that's 24%. That's pretty good money, probably better than you're making on your own products.
Yeah.
So there's another duality. If you have enough cash, you use completely different strategies.
Yeah, so what I think is important to realize here is, like you said, short-term gains are long-term pains. One of the things that you've got to realize as you're running the business is there are things that you can do, but once cash is fine, It might be you want to switch your process because you don't need the cash right now.
Yeah.
And you might be able to actually increase your margins by maybe extending terms to more clients or extending the term durations. And all these things aren't necessarily intuitive when you needed cash. You wouldn't do this if you needed cash. But now that cash is no longer the issue, this could actually increase your margins. And those are those 20% increases in net profit that you're wondering, how am I going to achieve this? Well, it doesn't mean you have to necessarily raise prices. You could just do this one strategy and bam, it's right to the bottom line.
Absolutely. Here's another one. You don't want to be the bank? Fine. Go find a bank. Happens all the time. You go into a used car dealership or a new car dealership. New car will try to get you to use their internal financing, right?
Yeah.
Used cars, they've got relationships with lenders. They know who will get them loans. So you go find a bank, and maybe you don't get anything out of it except for your clients can actually buy it. But there are credit cards that you can affiliate with that are specific to an industry. I was working with a company that did lawnmowers, chainsaws, etc., and some of them were pretty big ticket, these riding mowers.
Oh, yeah.
They had a credit card thing. You can't afford to pay cash, apply for credit, and they were specially for that particular industry. Or there's just people who want to lend money and you can associate with it, and either A, you're just making the sale, or B, sometimes they'll pay you for the referral. It's another strategy or two that I just mentioned. Here's another one.
Okay.
Every company should be going and getting a second bank account. 2 bank accounts minimum, one for checking, one for savings. So that's a strategy. But then another strategy is make it a high yield savings account. 4%, not a fraction of percent.
Yes.
And again, it doesn't make that much of a difference, but the getting the separate account is psychological. It helps you save.
Because you can't easily move the money.
Yeah, you want to generally get it at a different bank, but even if it's in the same bank, you can easily move it. You just know, you get used to over time. Those are reserves. Those are reserves. That's not what I want to use. This is the checking account. That's how much money I want to use. And then you make a little bit of interest on it.
Yeah.
And all of a sudden, maybe you can be making more interest than you're paying, or pay down your credit cards. Pay off high debt. That's obviously a strategy. But quite frankly, if you've got a cushion in the bank, I wouldn't pay off debt. You're paying for the cushion. You're paying for emergency prevention.
Yeah.
And you pay it down as you can. But I've seen people just say, well, I'm going to get rid of all my debt. And the next week they're in debt again because they haven't dealt how to manage it.
I appreciate you pointing that out. Yeah, you need cash reserves. To go down to zero isn't helpful, because then there's the emotional element of it.
Yeah.
You're now vulnerable because you don't have the reserves.
Yes. And one of the things that banking crises have taught us is that banks will cut your credit lines like that.
Yes.
No warning. And matter of fact, a strategy is, if something's going to happen in the economy and you're going, whoa, wait a minute, pull out money from your from your credit lines. If you think you're going to project and need them, pay the interest, because they won't call the loans if it's already out, but they will cut the lines if there's available credit.
Oh, that is excellent advice. I do appreciate that. That actually resonates with something I know of and I need to deal with. Okay, very good.
Okay.
So I'm going to now bring in the accounting a little bit more directly than we have already. Many accounting professionals are obviously out there doing the traditional bookkeeping services, accounting services, and so forth. Obviously, offering a service for a client that is specifically cash flow related, so that there's a process or program and engagement that they're doing with their clients for which they're paid directly for this service, is for some people very enticing, because they indirectly maybe just having conversations with their clients or helping them indirectly as it relates to their cash flow needs, but it's nothing structured. It's nothing that they're formally being paid for as an engagement. I'd like to talk to you about what you've seen accountants do to formalize their business relationships with their clients so that this is a service they're specifically providing and being paid for. How does that look? What does that entail?
So let me first start out with people who are starting new. Mm-hmm. I'm not going to say that they do it and get rich all of a sudden. They don't. Matter of fact, their first clients are oftentimes, I'm trying something new. Let me do this for you. I'm not going to charge you a penny. Mm-hmm. So they practice. But let's get beyond that.
Yes.
And what it looks like is generally putting together a structured offer. Consulting is hard to do. What I do to take something that's totally unstructured, but if you can put together an offer of, this is what I'll do, I'll set up a cash flow spreadsheet, and we're going to sit down on a periodic basis, whether it's once a week to begin with or every other week, doesn't really matter as much as that you're meeting with them and teaching them. And then you're either teaching somebody, well, if you're the bookkeeper, then great, do that, and you provide that service of the updates. If you're an accountant and they have an internal bookkeeper, then I teach. I don't do accounting, I don't do bookkeeping. I teach their financial pros to keep this stuff up to date. That's an option. And then you don't give reports. They don't need another report. They need a cash flow projection. I don't call that a report. What they need is to help find things that they can improve on. And I just gave a couple of obvious ones. They have a savings account. Is it a high yield account? And start helping them make these changes and say, you could improve. Here's an opportunity. And the interesting thing is all of a sudden you stop becoming a cost and you start becoming an ROI. And we did this once. I do a process called the blood wall. And we did it for a woman who had $100,000 on a zero yield savings account.
Okay.
And it turned out to be, $4,000 a year, which pays for a month's worth of advisory services, just to give away that little nugget, right? Little tiny nugget.
Yes.
But she pays for the services once, but she gets to leave the money in perpetuity. And so if you use compounding interest, this is, it's a $100,000 idea. And if you divide 76 by 4, whatever that comes out to, in 16 years, it's worth $100,000 to her. And these are the things that you report back and say, listen, what we just did just provided you with this much value over the next year, and you get to use it in perpetuity. And people start perceiving you not only as an advisor, but also somebody who's basically paying them. That might be a stretch.
It might be a little, but you're good.
You're getting a return on investment that is worthwhile. So I'm going to invest in you again next month and next month and next month. The trick is to always have ideas of how to help improve their business. But oftentimes, if they start improving, like I said, there's new strategies you can implement as they grow and as they're in better situation. And you keep working with them enough, you go back to the beginning and you can do it over again. And it's a wonderful thing.
I like that you've been able to kind of illustrate how that engagement might look, because as people move from offering bookkeeping services, accounting services, more into that CFO advisory space, this is exactly what's going on, is you're addressing the cash flow needs of that business, and you're helping them not with reporting, but you're literally helping them with implementation, ideas, strategies that they can implement to actually address this. It's not just reporting, here's what's happening. It's now strategizing with them on how to actually resolve the things that they're experiencing, and maybe giving them some insights on things that they wouldn't have otherwise considered. So that is what's happening as part of the engagement. And they're going to pay for this, especially if, as you mentioned, if you're coming each and every month with 1 or 2 additional strategies for them to consider. They don't have to implement everything you bring up, but it is for you to actually come and say, here's something you ought to consider. Have you thought of doing this? Is this something that you've done before? And they appreciate that because you're helping them get out of that day-to-day cycle of they just know what they know.
Yeah, and they pay well for it. I'll give you the other. I start out with your first client or 2 might be free. Now I'll give you the other side. One of the people who works with me is an accountant, trucking company, $1.5 million in revenue. Went from $1,800 a month contract for all their bookkeeping, accounting, and taxes to $5,000 a month, an incremental $3,200. Is that right?
Yeah, that's right.
Incremental $3,200 to do the advisory work. And the really interesting part is they spend a heck of a lot less time on advisory work than they do on accounting and bookkeeping because it's high value add.
Yes.
And all of a sudden you start having much higher, if you want to convert it to this dollar per hour, where you're no longer charging, and they're not looking at it like this. They're not looking at, well, you're making $75 an hour or $100 an hour, or $250 an hour. It is, and in reality is you're making $1,000 an hour, $500 an hour, but because you're charging flat fees, all they perceive is value, and it's worth it. It's more than worth it to pay the fees.
Yeah, if you can take to a $1.5 million business an idea that generates them $5,000, $10,000 in either savings or revenue, yeah, your services are well worth it. They're appreciative of what you're doing because you're impacting their business model, how they operate, what they're doing on a month-to-month basis because of the suggestion or ideas that you brought.
Yes, and we've talked about this particular client. We don't know who the client is. We just know generalities. You know, it's not $5,000 or $10,000 a year. It's $5,000 or $10,000 a month.
Yes, yes.
You can easily end up talking big numbers because these people are great people. We've talked about they established this wonderful business, but they're not operators.
Yeah.
This guy knows how to drive a truck and lease more trucks and hire drivers. He doesn't know how to run his business.
Yeah.
Which doesn't make him a bad person or stupid or anything else like that. It's just a skill he doesn't have. Okay, that's where you get to step in and help him run the business.
Well, back to something we said very early on, it's not so much that they don't know their business, it's that you're bringing the nuances of can you collect the revenues faster and can you pay the bills slower so that we can actually have this gap in the middle that we can benefit from. And when the business owner experiences that widening of the gap, the stresses start to go away. Yeah. And it's not so much that they're driving the trucks differently or employing the drivers differently. It's all of a sudden just the nuances of the business as to how they're actually working with vendors and their employees. It's the fun side of the business, in my opinion, because it's the creative side. And that's one of the things I do enjoy about the advisory in business. So yeah, this is very good.
Well, just one more quick idea. And sometimes it's not what they think it's not what they think they want that they really want. This guy keeps adding trucks, but his life gets more and more complicated. And so one of the suggestions was reduce the number and live your life. You're making enough money. And we don't know how that's going to come out because that just happened, in February, and it's tax season, so we won't talk about it again until a little bit later.
Yeah, sometimes less is more.
Absolutely. What are you trying to accomplish? And this is one of the things a lot of business owners don't really realize of what they want to really ultimately accomplish. And this goes well beyond accounting. This is true advisory. And if what you help them realize is not what they think they want, not growing and growing and growing, but having a really profitable business that allows them to take 6 weeks of vacation a year, you can show them how to do it using the numbers and then facilitate that with the operational things that'll help them get there.
That's right. Real quickly, I want to go into two things here. I'm going to ask a question regarding, you've got a model that you use as it relates to cash flow management. You received an award at GrowCon in 2024 for it. It's something that you're bringing to the accounting community as a tool that can be used to help address cash flow. I understand that's going online now.
It is. As you and I are talking, it is being programmed. By the time this releases in 2 or 3 months, it will be available. And it is software. I've now documented 239 strategies. It'll be more than that by the time this airs. And I've identified the different filters is what we can use filters, but there are different aspects and qualities of each strategy. How high is the risk? Is it high, medium, or low? How long does it take to implement? Can you do it immediately? Or will it take days, weeks, months, or even years to implement some of these strategies? Who gets the benefit short term? For example, when you do a discount, your client gets the immediate benefit and you get the benefit as well. Who gets the benefit long term? They do. This whole issue of short term versus long term cash, that's in there. So you can get rid of the ones once you've got enough cash in the bank, you come from a position of strength, you get rid of all those cash losing strategies. So it's really great on a spreadsheet, and now I'm putting it online to make it more generally available to people.
I love it. No, I appreciate the fact that you've actually taken your experience and all these strategies and you've put them together in a useful way of trying to identify of 239 strategies or more, which are the right ones that I can do today. And as an accounting professional, to be able to whittle that down to something that's actionable, 1, 2, or 3 that I can take to my clients, that's powerful because it allows you to identify what am I going to bring to the table as that advisor.
Yeah.
So I think that's powerful.
And it uses HI, human intelligence. Right now I'm putting my human intelligence into this tool and it's filtered. And then it requires somebody like you to come in and say, okay, here's the situation. Oh, wow, it's down to 10. So you still have to say, what are the best ones based on their circumstances? Or pull out 2 or 3. Companies cannot handle 10 at a time.
Correct. Yeah, it's 1 or 2.
1 or 2. Or you say, here's 3 ideas. Which one do we want to work on?
Yeah.
It just depends. And so you use your intelligence to work with it. I will be implementing AI, but it won't. It's because it'll help people know the questions to ask. Right now, people need to learn, well, what does this mean? Bookkeeping, found in bookkeeping, what does that mean? It means if you're a bookkeeper, you can figure this out if you just look at the books. Well, what does this mean? Accounting reports. It means you can figure out if this strategy can be applied if you just have reports. So there's different things. And so the tool eventually will help and describe what it is and possibly provide resources. Those debit cards, that's my first resource. That will end up linking. So you go, great, there's a resource. So I don't have to go out and do my own research. If I live in Canada, I've got 4 choices. I live in the United States, there's 12.
Yeah.
So that's the goal long term. First version will be simpler, and it's just going to keep growing from there.
I love it. Well, congratulations on doing this because I think this is a great tool or asset to be providing. So thank you for it. What are you grateful for?
I'm grateful to God who gave me a mind that I can figure this stuff out. Roger, I have so much fun doing this. My goal is to just be able to help 1 million companies. And so I'm trying to figure out ways to do that. I'm certainly grateful for my family, my wife. She's also my business partner, which is people go, oh, and we say, yeah, it took some work, but we have fun. Now it's strange when we're apart. And I'm really grateful for friends and associates like you.
Thank you.
I mean, we've known each other now 4 or 5 years.
Yes.
And the relationships get stronger. And it's really important to have good relationships with people, with my clients. And yeah.
I love it. I love it. And yes, it has been a good friendship. So here's what I'm going to do. I'm going to start wrapping this up. And as I do this, I'm going to come back to you for a closing thought.
Okay.
So first thing I want to do is to my audience, if you haven't already, I want you to go to the episode description because there you're going to find information regarding David's release of this new platform so that you can actually look at it and utilize it as it relates to your clients and actually help them with regards to cash flow. In addition to this, I want to invite you to read the book Red to Black. It also actually addresses a variety of cash flow things that are specific to what it is you can do as a how-to guide for accounting professionals to help your clients as it relates to cash flow. So definitely check that out and become a profit and growth expert for your clients. I also want to invite you to the Accountrepreneurs Challenge. The Accountrepreneurs Challenge is something we've put together as a 90-day exercise for you to work on both your personal and professional things as it relates to your business. It's here each week that you're going to be given an exercise that literally can be nothing more than 5-10 minutes for the week, or perhaps it's a course or a book to read that may take you an hour or so for that week. But the point is each and every week you're going to be given something to specifically do as it relates to either you as a leader, as an individual, so that you can actually work on your personal as well as your professional, such as your business plan and so forth. These are the things over the next 90 days that you can actually do today so that this can be the best year yet as it relates to your business. So take a moment, sign up for the Accountrepreneurs Challenge. You can go to universalaccounting.com unpack.com/podcast for information regarding this information for the episode and so forth. The other thing I want to invite you to is GrowCon. GrowCon is our annual conference. It is an event that you do not want to miss. It is a conference for owners of bookkeeping, accounting, and tax businesses. It's here that we have the experts come and speak to us. It's where we get to interact with our peers, those individuals like us that are out there struggling as we are to have a successful business, as well as thriving to have the premier accounting firms in their area come, learn, experience, and perhaps even collaborate with them to better service your clients. Join with us, build some wonderful friendships and relationships as it relates to the accounting community. And then lastly, you get to meet myself and my crew, those individuals who are committed to helping you be in business for yourself, but not by yourself with Universal Accounting. Lastly, I want to invite you to actually check out information as it relates to not only the programs that Universal Accounting offers, but the various tools and resources that are intended to actually help you work on your business. Go to universalaccounting.com and you'll find not only information regarding the podcast, but also you'll find their information regarding GrowCon as well as these different offers. So go to universalaccounting.com/podcast for more information. Now, with all that said, this has been a phenomenal conversation. I want to summarize a few of the highlights. One is recognizing that David's perspective, having come from corporate America, is definitely a unique and wonderful addition to the accounting perspective, because I believe it helps us realize as accounting professionals that sometimes that dogma that we bring to the accounting reports that we use with our clients can be distracting from what matters most for many of our clients. That as small business owners, it's the cash flow that resonates so much with them. And oftentimes the accrual reports that we may be providing may be distracting from what it is they're experiencing. They're confused, and ultimately they may be frustrated and not willing to really kind of reveal themselves. We spoke of how obviously there might be intimidations that happen or that glazed over look. And I think those things are things that we all experience with our clients, and I think we need to recognize that. One of the things I also appreciated was how David illustrated that there needs to be kind of a bedside manner, as I described it, as it relates to our conversations with our clients. We just need to be a little bit more sensitive to what it is they're experiencing, and I think that's something that is worth noting. The other thing that we brought out was David mentioned that there is this stress or emotion that's associated with the business that's beyond their personal situation, but it's the realization that so many of these individuals have family members and friends that are interwoven within the success of the company, and we have to understand that those are the stresses that they're experiencing as they're running their businesses. I love the fact that David was able to share and volunteer so many wonderful suggestions and ideas, and sometimes they were counterintuitive, meaning it was obvious that one thing would work, but maybe the opposite is more effective for the client. And I thought that was a great illustration of various methods that we can use to address cash flow needs as they relate to business clients of ours. And then lastly, it was this whole idea of when we work with our clients, we need to be asking the right questions, and we need to respect the fact that they know their business, but bring them maybe 1 or 2, 3 action-related items, actions that they can implement in their business as they so choose to address their cash flow needs. So wonderful suggestions and ideas. So David, what would you like to end with?
Well, there's some people out there listening right now, some men and women who feel like they're frustrated. They see these issues with their clients. They can tell as they do the bookkeeping, they do the accounting, they can see the cash challenges that their clients are facing, and they don't know how to help. For those people, I would like to invite you to come talk to me, set an appointment. Let's talk for 30 minutes. I don't sell. I see if there's a good fit. And if you want to help your clients, there is a methodology that you can help any client work its way out of cash flow challenges. That's my invitation. That's what I'd like to end with. There's a small number who really want to help their clients. Other people want to really do well at bookkeeping and accounting, which is great. Everybody wants to help, but some people want to take that next step.
Oh, yes. And what's a good way of reaching you? LinkedIn, is that
LinkedIn is a great way. It's David Saphir. The notes will have it.
Yes.
But we'll also put a calendar invitation in there.
Good.
And if it's okay, I'll even put my phone number in there. I've actually had somebody who watched your show and called me, and it was great. He's the only person who ever has. So if there's somebody else listening who wants to call, I'd love a phone call. I love
it. So in the episode description, we'll put your contact information and encourage everyone to reach out. And I think that'd be a wonderful thing to do. So thank you for that. Well, David, I'm going to wrap this up by first of all saying, if you haven't already subscribed to the podcast, I definitely want to invite you to to do so, go and subscribe to whichever platform you prefer and set your notifications so that each and every week you can get notified as to our releasing of a new episode. We do one every Wednesday, and we'd love to have you listen in to what it is that the experts have to share as it relates to running and having the premier accounting firm in your area. Also, as it relates to the various discussions that we've had here today, if you'd like to go and binge listen them, we've compiled from our more than 300 episodes playlists that actually tackle the various topics that may be relative to your current situation today. So go to universalaccounting.com, and in the navigation, you'll find the podcast section. There you'll find highlights where the playlists exist, where we've put together things related to marketing, selling, pricing, tech stacks, mental health, just a variety of topics that are perhaps specific to your current situation, and I encourage you to binge listen those as well. Also, as it relates to this, I do want to encourage you again to take advantage of the Accountrepreneurs Challenge, as well as reading the book Red to Black. Those are excellent things to actually assist you as it relates to your cash flow situations that you're experiencing with your clients. And then the last thing, if you'd like more information regarding this and other things that we've discussed on the show, feel free to reach out to us. You can contact us by going to universalaccountingschool.com or giving us a phone call at 801-265-3777. And always remember this, accounting success is universal. Take care and have a great day and be safe out there.